It's different when you have an existing customer. That dialogue's already ongoing and you have a really good understanding of what the growth and the pathway for the operator looks like. But for certainly for a new customer, it's important to engage as early as possible. As you've sort of spoken about previously, Chris, there's a long tail, or there's a long lead in time for developments, from conceptualization to development and planning to actually the project delivery itself and then trade up. So there's a lot of things that happen through that phase, and I think it's important to engage with the bank early for a few reasons. I think there's three probably key reasons, and you touched on it as well, Graham. But firstly, it's being able to be on the same page as the operator, understand what their goals and objectives are, and equally have a good working relationship with the management team, understanding what the board directive is as well. Secondly, we at Westpac have a community, a network of specialised dedicated health bankers across the country who are focused on seniors living. So that in itself provides some insights into what we're seeing across the country in different developments, from small developments right through to very large scale institutional customers that probably Louise could speak to in a little bit more detail. But I think there's certainly things that we can provide in terms of what we're seeing from a benchmarking perspective of how things are taking time, or sort of the time frame things take to develop and build.
Some of the reasons it's worth getting banker involved earlier than you might expect is particularly on deciding on the staging of a project. So we find quite often the customer might have already made a decision about staging they think works best from the economics, but we can show some different scenarios about recycling equity through that project, or how you might be able to save some money on the construction by running the stages side by side, and what the sort of additional risk is on that. So we're quite happy to get involved and give some suggestions. It's not uncommon that we get brought in maybe a bit too late, where a builder might have already been decided on and that builder's not deemed acceptable by the bank for various reasons. Usually it's because they've got too many large projects on the go and concerns about cash flow, or they just haven't got the track record of doing projects of that size. In the current environment, the banks are very, very focused on the builder. So we like to get involved when even a shortlist is being put together. And we also find as well, a lot of the customers aren't doing much financial due diligence themselves on the builders. So as part of our due diligence, we always need to see the financials on the builder. And it's so rare that the customer's ever asked for them, which I think should just be part of any tender process. Give me your financials, give me your cash flow forecast. Everyone should be doing that, whether or not they're bank funding a project or not. So that's some really good reasons to get us in early. Another thing we see quite often is that maybe a valuation's been done, but not on a basis that a bank can accept for a mortgage. So it might be a real estate style valuation. And the lead time on valuations is going to be about sort of 3-4 months. So if you bring the bank in too late, you've got a valuation that a bank can't accept. You might be setting yourself back a few months getting a new valuation done. So I'd always recommend work with a specialised aged care or retirement valuer. And when you're talking to them, even if you're not speaking to banks yet, let them know that you're thinking about financing, because they know what the banks need for a valuation that can be used for mortgage purposes. Just saves yourself doing double work. Quite often, CEO, CFO might want to go to the board with an indicative funding structure. So they might already want to have fleshed something out. Quite often they'll go, here's our 2 scenarios, do it all in one stage. We save this building cost, but we've got this additional equity contribution, or do it across a couple of stages. So it's good to run those ideas past a banker and get some endorsement. So by the time you go to the board, you can say, well, this is sort of roughly what our funding will cost, and this is sort of a general idea of the terms we might be able to get. That's going to be a lot better for you to get that board approval ready to go than to come back later and say, oh, actually, I had to change everything because we couldn't make that staging work. Can you approve this new plan?
So knowledge has certainly improved. I think there's a greater shared, I suppose, market for, I suppose, to some extent, being collegial about this, and a certain camaraderie about the knowledge, and some of that free service which I'm hearing about from Louise and from Kai is very, very good. And I certainly hadn't thought about all of that. That there's a lot of very good free knowledge out there that we can utilize as operators. And I don't think we do that enough, but we certainly can, and I certainly shall be.